Welcome to Talk Tickers.
It's great to be here.
Today, we're not just talking about a bad trade. We're not even really talking about a market correction. We are opening the dossier on, for lack of a better term, a ghost story.
A ghost story is a perfect way to put it. A financial ghost story.
I mean, imagine this. Imagine a $20 billion fortune that, for all intents and purposes, was invisible. It didn't exist on paper.
Right. Not on any public record anyway.
It didn't show up in the 13F filings that you or I can go and look up online. And yet this ghost in the machine held more economic exposure to some of America's biggest media companies than their actual publicly listed largest shareholders.
It's an incredible story. And it's the story of Archegos Capital Management. And honestly, it's a masterclass in how the plumbing of Wall Street, how it really works, and how it fails spectacularly.
And that's what we're going to do today. We're going to dissect the implosion of Archegos.
Yeah.
This wasn't just some small fund blowing up. This event vaporized $10 billion of bank capital.
Just gone in a matter of days.
It completely humiliated some of the world's oldest, most respected financial institutions. And maybe most importantly, it revealed a regulatory blind spot so enormous you could drive a fleet of trucks through it.
A very, very large fleet of trucks, yeah.
So in this deep dive, we're going to look at the man behind it all, Bill Hwang. We're going to break down the mechanics of the trade, specifically something called a total return swap.
And an even more obscure version called a bullet swap, which sounds dangerous for a reason.
It really does. And then we're going to really focus on the institutional failures, particularly at Credit Suisse, that allowed this whole thing to happen in the first place.
And I think it's important to say right up front, this matters. This isn't just some, arcane Wall Street story. It matters to you, our listener, even if you don't run a multi-billion-dollar family office.
Right. Why should someone listening at home care about this?
Because it exposes the critical difference between what we call public leverage, the stuff you can see in filings, and synthetic leverage. Synthetic leverage is like the dark matter of the financial universe. You can't see it, but it has immense gravity. And when it collapses, it pulls everything else down with it.
Okay, so let's set the scene. It's March of 2021. The market is, I think frothy is a good word for it.
Very frothy. Everything was going up.
And then all of a sudden, over a span of maybe 48 hours, these massive block trades start hitting the tape. We're talking ViacomCBS, Discovery, Tencent Music.
Billions and billions of dollars of stock just being dumped onto the market for seemingly no reason.
And that was the terrifying part, right?
Right.
Nobody knew why. I mean, you're a Viacom shareholder, you wake up and your stock is down 30% and there's no news.
Nothing. The fundamentals of these companies hadn't changed overnight. Viacom hadn't suddenly declared bankruptcy. Discovery didn't lose all its subscribers, but the stock was being cut in half. It was a purely mechanical event, a liquidity event.
And it turns out, after the dust settled, that it was all coming from one place, one entity.
One guy, essentially, Archegos.
So let's start right there. What or who was Archegos? Because it wasn't a hedge fund, which is what I think most people would assume.
That's the key distinction. To understand this whole story, you have to get the difference between a hedge fund and what Archegos was, which was a family office.
Which sounds so quaint, doesn't it? A family office. It sounds like a cozy little operation where you manage your inheritance.
It can be.
Oh.
But in this case, the term family office was really a regulatory cloak of invisibility. It was set up to manage the personal wealth of one person, Bill Hwang.
And because it wasn't managing outside money.
Exactly. No pensions, no university endowments, no teachers' retirement funds. Because he was only managing his own family's money, he was exempt from having to register as an investment advisor under the Dodd-Frank Act.
So the logic is, if you're only risking your own fortune, the government's attitude is basically, hey, it's your money, go nuts.
That's precisely it. And here's the most critical consequence of that exemption. Family offices don't have to file a Form 13F.
Okay, let's pause on that. A 13F. For anyone who doesn't know, this is kind of the public report card, right? Mm-hmm. If I'm a big hedge fund manager like Bill Ackman or Warren Buffett, and I buy a huge chunk of a company, I have to tell the world about it every quarter.
You do. It provides transparency. It tells the market who the big players are, who owns what. It's a cornerstone of market transparency. But Archegos didn't file them. They were exempt. And this allowed them to operate in total darkness.
And they used that darkness to build a position size that was, the numbers are just hard to comprehend.
They're astronomical. At its peak, we're talking about roughly $120 billion in gross exposure.
120 billion.
Yep. And that was on a capital base of about $20 billion.
So if you do the quick math on that, that's leverage of, 6 to 1?
It fluctuated. Depending on the day and the positions, it was somewhere between 5x and 8x leverage.
8 times leverage.
Now, context here is key, right? If you're a bond trader at a bank and you're trading U.S. Treasuries, 8x leverages. That's a Tuesday. It's boring.
Because the asset isn't volatile.
It barely moves. But Archegos was not trading treasuries. They were running a highly concentrated long-short equity strategy focused on TMT tech, media, and telecom.
So names like Viacom, Baidu, GSX Tekadu, these are not sleepy, stable companies.
Not at all. These are highly volatile growth stocks. So running 8x leverage on a concentrated portfolio of stocks like that, it's not investing. It's tightrope walking across the Grand Canyon in a hurricane.
And without a safety net.
Oh, there was a net. The problem was the net was made of tissue paper and the banks were the ones holding it.
So let's talk about the man on that tightrope, Bill Hwang. This isn't some random guy who got lucky. This man has a serious pedigree in the hedge fund world.
He absolutely does. Bill Hwang is what they call a tiger cub.
Which means he came from the legendary Tiger Management, Julian Robertson's firm.
Exactly. Julian Robertson was one of the titans of 20th century finance. He was famous for his rigorous research and for spawning an entire generation of incredibly successful hedge fund managers who went out on their own. They were called the Tiger Cubs. And Hwang was considered one of the very best.
So he starts his own firm.
He does. He founded Tiger Asia Management back in 2001, specialized in Asian markets, and for a decade, he absolutely crushed it. He had incredible returns.
Yeah, but with a story like this, there's always a but.
There is a massive but, a huge one. In 2012, the whole thing came crashing down for Tiger Asia. Hwang and his firm pleaded guilty to federal charges of wire fraud.
Wire fraud.
And on top of that, he settled civil charges with the SEC for insider trading related to Chinese bank stocks.
Insider trading. I mean, in this industry, that is the cardinal sin. You don't come back from that.
It is. The allegation was that he was getting confidential information from banks about upcoming private placements and then using that information to short sell the stocks ahead of the announcement. He paid $44 million in fines. He was banned from trading in Hong Kong for 4 years. He was, for all intents and purposes, kicked out of the club, an outcast.
So his reputation is in tatters. He has to return all the outside capital from Tiger Asia.
Yeah.
The firm is effectively dead.
Dead and buried. But Bill Hwang isn't dead. And he still has a lot of money. So he takes his personal fortune, which at the time was around $200 million, and he converts the firm into Archegos, his own private family office.
And this is the psychological part I find so fascinating. You get publicly shamed. You get kicked out of the game. You pay the fine. You still have $200 million. Most people would just, buy an island and retire. Why double down and get back in the game?
I think it's about redemption, validation. There's a deeply, deeply competitive nature to these Tiger Cubs. They're driven to win. I think Hwang wanted to prove that he could still do it, that he was still one of the greats, and prove that he could win and win bigger than ever before.
And boy, did he ever.
He did. He turned that $200 million into $20 billion in less than a decade. That is one of the single greatest runs of performance in modern financial history. Full stop.
That is just a staggering number.
It is. And it made him confident. You could argue it made him overconfident. But here's the catch. Because of his past, the wire fraud, the insider trading settlement, he was radioactive on Wall Street, the big prime brokers, your Goldman Sachs, your Morgan Stanley.
Yeah.
They blacklisted him.
They wouldn't touch him.
Initially, they wouldn't trade with him at all. But Wall Street, as we know, has a very, very short memory when there are huge fees involved.
The old greed trumps fear mechanic.
Mm-hmm. It's a tale as old as time. As Archegos grew from a couple $100 million to billions and then tens of billions, the commissions they were generating were enormous. We are talking tens, maybe hundreds of millions of dollars in fees annually.
And the prime brokerage divisions at these banks, they live on that stuff.
They do. It's a volume business with thin margins. So they started looking at Hwang again and thinking, well, maybe he's changed. Maybe that insider trading thing wasn't that bad. The money was just too good to ignore.
And so, one by one, they folded.
They all came back to the table. Credit Suisse, Nomura, Morgan Stanley, eventually even Goldman Sachs. They all welcomed him back. They opened the door and they let the ghost right back in.
Okay, so let's get into the how. This is the engine room of the whole story. How do you possibly buy $120 billion worth of stock without anyone seeing you and without putting up $120 billion?
It's the magic trick. You don't buy the stock, you buy the exposure to the stock. And you do it using a derivative called total return swap, or a TRS.
Okay, break this down for us like we're five. I'm an investor. I want to buy, let's say, 1,000 shares of Viacom. Normally, I call my broker, I pay cash, the shares show up in my account. How is a TRS different?
So with a TRS, Archegos doesn't call a broker to buy shares. Instead, they call the swap desk at a bank like Credit Suisse, and they say, I want the economic return of $100 million worth of Viacom, but I don't want to actually own it.
Okay.
Credit Suisse says, fine, we'll write a contract. The contract says that if Viacom's stock price goes up, Credit Suisse pays the profit to Archegos. If Viacom pays a dividend, Credit Suisse passes that along to Archegos too. Archegos gets the total return of the stock.
And what does Archegos have to pay in return?
They pay a financing fee. It's basically an interest rate, usually a benchmark like SOFR plus a spread. And of course, the other key part is if the stock goes down, Archegos has to pay Credit Suisse for the losses.
So it's a synthetic position. It's a bet on the direction of the stock.
It's a pure synthetic. Now, Credit Suisse isn't in the business of just taking the other side of that bet. They don't want to gamble against their clients. So to protect themselves, to hedge their risk, Credit Suisse goes into the actual stock market and buys $100 million worth of the real Viacom shares.
Ah, okay. But critically, those shares are held in Credit Suisse's name.
That's the $1 million, or in this case, $1 billion insight. On the official shareholder registry, the legal owner is Credit Suisse. It doesn't say Archegos Capital Management anywhere.
So Bill Hwang is completely invisible to the market.
Total anonymity. And here is the real kicker, the source of all the power and all the danger: leverage. To enter into this $100 million swap, Archegos doesn't have to put up $100 million in cash. They only have to post a small fraction of that, which is called initial margin.
Like a down payment.
Exactly like a down payment. Maybe it's 15%. So for just $15 million of their own cash, they get to control $100 million worth of stock.
Which sounds absolutely fantastic when the stock is going up.
It's rocket fuel for your returns. It's how he turned $200 million into $20 billion. But there was a very specific and very dangerous feature in the swaps that Archegos favored, which made the situation infinitely more toxic. They insisted on using bullet swaps.
Bullet swaps. Okay, I teased this in the intro. This is where the math gets really interesting and frankly really scary. How is a bullet swap different from a regular vanilla swap?
Okay, so in a standard swap agreement, there's usually a reset period. Let's say it's every month. So you have your $100 million position. In month one, the stock does great, and it's now worth $110 million. You've made $10 million.
Right.
In a standard swap, at the end of the month, you settle up. The bank might pay you out that $10 million, or you roll it into the position. But the key is the margin requirement is recalculated based on the new higher value of the portfolio. It keeps everything in line.
It keeps the leverage ratio from getting out of whack.
Exactly. It forces discipline on the position. A bullet swap. A bullet swap does not reset until maturity. And Archegos was negotiating these swaps with 24-month tenors. 2 full years.
Wait, 2 years with no reset?
2 years. So now imagine that same scenario with a bullet swap. You put down, let's say, $10 million in margin to control a $100 million position. And that stock just rips higher. It doubles. It's now worth $200 million.
Okay, so I've made $100 million on paper.
You have $100 million in unrealized profit. You now have $110 million in total equity in the trade. But, and this is the crucial part, because the swap hasn't reset, the bank is still only holding your original $10 million in margin.
So the position doubled in size, but the cash collateral, the safety buffer at the bank, it stayed the same.
Exactly. This is a phenomenon called margin erosion. As the stock price went up, Archegos' effective leverage on the position secretly increased because they weren't being forced to post more margin to reflect the bigger size and bigger risk. They were winning, but their structural risk was skyrocketing at the same time.
That is completely counterintuitive.
Yep.
Usually, the more you win in a trade, the safer your position gets. But here, winning just made the house of cards taller and much, much more unstable.
You've hit the nail on the head. And remember, this wasn't happening in a vacuum. Archegos wasn't just doing this with one bank. They were doing it with everyone. And this is what the risk reports called the loading effect.
Explain what that means. Loading.
So if you or I walk into a bank to get a mortgage, what's the first thing they do? They run a credit check. They can see if you already have 5 other mortgages at 5 other banks. They see your total indebtedness.
Right. They see the whole picture.
In the world of prime brokerage, especially with a secretive family office, Bank A doesn't necessarily know what you were doing over at Bank B, C, and D. There was no central clearinghouse for this risk.
So Archegos could go to Credit Suisse and buy, say, $1 billion of Viacom via a swap. Then they hang up, call Morgan Stanley, and do the exact same thing. Another $1 billion. Then Goldman. Then Nomura.
Precisely. And each bank is looking at its own little slice. Their risk department runs the numbers and thinks, okay, this is a big position in Viacom, but it's a liquid stock. If something goes wrong and we need to sell our $1 billion worth, there's plenty of volume in the market to absorb it.
But what none of them realized was that Archegos was the market in that stock.
They were the whale, the only whale. In some of these names, they had built up economic interests that exceeded 10% or even 20% of the company's entire publicly traded float. So if all the banks tried to liquidate their positions at the same time, there would be no buyers on the other side. Because the only person who had been buying for the last year was Bill Hwang.
It's like a circular firing squad. But none of the shooters know that the other people are in the room.
That's a perfect analogy. And it all worked beautifully, this whole invisible empire, until the music stopped.
Okay, let's pivot to the institutional failure side of this.
Yeah.
Because, look, you can blame Bill Hwang for being aggressive, for taking on too much risk. But the banks are supposed to be the adults in the room. They have entire departments, entire floors of people dedicated to risk management.
They're the gatekeepers.
Exactly. And Credit Suisse. They lost $5.5 billion. That's not just a rounding error. That's a catastrophic failure. How did it happen?
The post-mortem that Credit Suisse itself commissioned is one of the most damning internal review documents I've ever read in finance. It just details a complete and total collapse of risk culture from top to bottom.
Let's start with that static versus dynamic margining issue you mentioned.
Right. So we talked about the danger of the bullet swaps. The reason they were so dangerous at Credit Suisse was because the bank was using what's called static margining. They set a fixed dollar amount of margin required for a trade and just left it. The rest of the industry, for the most part, your Goldmans, your Morgan Stanleys, had already moved on to dynamic margining.
And dynamic means it adjusts automatically based on the risk profile of the portfolio.
Correct. If your portfolio gets more concentrated in one stock, or if the volatility of your holdings spikes, a dynamic margin system automatically demands more cash from you immediately. It's a real-time risk mitigation tool.
And Credit Suisse just didn't have that.
Well, here's the crazy part. They knew they should have it. They had agreed in principle that they needed to move high-risk clients like Archegos onto a dynamic system. They were in the process of trying to do it.
Yeah. What happened?
Archegos said no. They pushed back hard. And the business side at Credit Suisse folded like a cheap suit.
Why? Why would they let the client dictate the bank's risk policy?
One word. Fees. Revenue. Archegos was a top 5 client for the entire prime brokerage division. They were a cash cow. The relationship managers were terrified that if they pushed Hwang too hard on something like margin, he would just pick up the phone and move his entire massive book of business to a competitor who would give him easier terms.
So they let him stay on the old, risky, static margin system.
They did. And the result was that Archegos was posting, on average, about 7.5% margin on these incredibly risky equity stops.
7.5%. That's insane.
It's unbelievable. For context, if you have a standard prime brokerage cash account, your margin requirement is usually 15 to 20%. Minimum. Credit Suisse was effectively subsidizing his risk-taking by giving him the cheapest leverage on the street.
And the actual risk managers, the people whose job it is to prevent this, were they okay with it?
Not at all. The internal documents show the alarm bells were ringing constantly. Archegos was persistently, almost continuously, breaching its own internal risk limits.
So banks have these internal thresholds, right? Potential exposure limits, scenario stress test limits.
Exactly. And Archegos was just smashing through them on a regular basis. You have a risk dashboard that is just flashing red, red, red all over the place.
And instead of slamming on the brakes and forcing Archegos to reduce its risk,
the managers just raised the speed limit over and over again. They would grant temporary waivers that became permanent. They would retroactively increase the limits to accommodate the breaches. They completely normalized the deviance. It was a classic case of letting the business run the risk department, not the other way around.
the report calls this the juniorization of risk. What does that mean?
It's a huge cultural problem that was happening at the bank. In the years leading up to 2021, Credit Suisse had seen a lot of senior experienced talent leave its risk department. These were people with the authority and the backbone to say no to the business. They were replaced by more junior staff or people without deep risk expertise.
And then you had this problem of double hatting.
Yes, this is maybe the most shocking part. You had senior executives who were in charge of prime services. Their job was sales, bringing in revenue, wining and dining clients like Bill Hwang, who were also the ones responsible for signing off on risk exceptions for those same clients.
That's a textbook conflict of interest. That's literally the fox guarding the henhouse.
It is. It's a fundamentally broken structure. If my year-end bonus is tied directly to the revenue a client generates, and I also get to decide whether that client's incredibly risky trade is acceptable, I am heavily incentivized to approve the trade. The report showed that the first line of defense, which is the business unit itself, was completely and utterly ineffective at policing itself.
There was also this intellectual trap they fell into, this bias trap. They looked at the Archegos portfolio and thought it was hedged.
This is a classic risk management mistake. They looked at the top line numbers and saw, okay, Archegos is long $50 billion of stocks, and they're short $50 billion of stocks. Their net exposure is basically zero. They're safe. They're market neutral.
But not all longs and shorts are created equal, are they?
Not even close. The longs were this highly concentrated basket of specific volatile names we've been talking about. Viacom, Discovery, Baidu. The shorts were just broad market indices. The S&P 500, the NASDAQ. This is a fatal mismatch between what we call idiosyncratic risk and systematic risk.
Okay, put that in plain English for us.
It means that if the entire stock market crashes, your index shorts will make a lot of money and protect you from your longs falling. That's a systematic hedge. But if the broad market stays flat or even goes up a little, but Viacom specifically crashes because of some company-specific news, your S&P 500 short provides you with zero protection. You are completely naked to that idiosyncratic single stock risk.
And that is exactly the scenario that played out.
To a T. It was the perfect storm they had built for themselves.
So let's get to the timeline. March 2021, the final days. What was the catalyst? What was the single event that pricked this massive bubble?
It's almost anticlimactic, really. It was a seemingly routine corporate finance event. ViacomCBS stock had been on an absolute tear. It had more than tripled in a few months, driven largely by Archegos' buying. The company's management, quite sensibly, decided to take advantage of that sky-high stock price to raise some cash. They announced a secondary stock offering.
Which is pretty normal. It dilutes existing shareholders a bit, so the stock usually takes a small dip.
Right. A small, manageable dip. But for whatever reason, the market reacted very poorly this time. The stock dropped more than expected. And at the exact same time, halfway around the world in China, regulators started making noise about cracking down on for-profit education and tech companies. This hammered Archegos' other huge holdings, Tencent Music, Baidu, and especially a company called GSX Techedu.
So all of his big, long positions start falling at once.
They all start cracking simultaneously. And remember that 5x to 8x leverage. A 5% drop in a stock price doesn't cause a 5% loss in your equity. It causes a 25 or 40% loss. A small drop in the asset value creates a massive catastrophic hole in your capital.
The bullet swaps, the margin erosion, none of that matters anymore because the total value of the portfolio is just collapsing.
It's in free fall. And so the banks, all of them, issue margin calls. The phones start ringing off the hook at Archegos. Bill, the value of your collateral has plummeted. We need cash. We need billions of dollars now.
But Bill Hwang didn't have it.
He was completely tapped out. Every dollar of unencumbered cash had been plowed back into the portfolio to add more leverage. They couldn't meet the calls.
And this leads us to the scene that, for me, defines this entire saga. The late-night meeting, the attempt to orchestrate a standstill.
You have to just imagine this Zoom call. It's late in the evening. Panic is clearly setting in across Wall Street. And on this call, you have senior representatives from Credit Suisse, Nomura, Goldman Sachs, Morgan Stanley, UBS, Deutsche Bank, the biggest, most powerful banks in the world. And on the other side of the screen is Bill Hwang's team.
What happens on that call?
Hwang's CFO essentially admits the truth. He opens the kimono, as they say. He tells them, gentlemen, the situation is dire. We have approximately $120 billion in gross exposure, and we have maybe $9 or $10 billion of equity left.
The silence in that virtual room must have been deafening.
He was admitting he was wiped out, he was insolvent. If they started liquidating his portfolio, he was finished. So he pleads with them, he asks for a standstill, he says, please do not sell. If everyone rushes for the exit at once, we will crash these stock prices to zero, and everyone on this call will lose billions. But if we work together, if we unwind this portfolio slowly and carefully over the next few weeks, maybe we can salvage the situation.
It's the prisoner's dilemma.
It is textbook game theory. A perfect real-world example. You have a group of prisoners. If they all cooperate and stay silent, they all get a light sentence. But if one of them defects and rats the others out, the defector goes free and everyone else gets a life sentence.
And in this scenario, ratting them out means selling the stock immediately.
That's the defection. If everyone holds their positions and cooperates, maybe the prices stabilize. But if Goldman Sachs decides to sell first, they get out at $90 a share. By the time Credit Suisse gets around to selling, the stock might be at $40. Goldman gets the best price, and everyone who waited gets stuck holding the bag.
And let's be clear, these banks are not friends. They are ferocious competitors. They don't trust each other.
There is zero honor among prime brokers in a crisis. So Goldman Sachs and Morgan Stanley, they looked at the numbers, they saw the sheer size of the positions across the street, and they came to a very quick and very rational conclusion. This ship is sinking, and there are not enough lifeboats for everyone.
So what did they do?
They didn't agree to the standstill. They gave some non-committal answers on the call, hung up the phone, and immediately started hitting the sell button with extreme prejudice.
They started executing block trades.
Massive, massive block trades. That night and into the next morning, they seized the collateral, the actual shares of Viacom and Discovery they were holding as a hedge, and they dumped them on the market for whatever price they could get. Goldman sold billions, Morgan Stanley sold billions. They were first out the door.
And Credit Suisse and Nomura.
They hesitated. Whether they were genuinely hoping the standstill would work or whether their own internal bureaucracy was too slow and sclerotic to approve the sale quickly, they waited. They waited overnight. And by the time they tried to sell their positions the next morning, the market was already flooded with shares from Goldman and Morgan Stanley. The prices were in a nosedive.
And that one-night delay, that hesitation, cost Credit Suisse $5.5 billion.
$5.5 billion. It cost Nomura nearly $3 billion. Goldman Sachs and Morgan Stanley, they got out almost completely unscathed. I think Goldman reported their losses effectively zero. Morgan Stanley lost under $1 billion.
It's just brutal. It proves that old Wall Street adage that in a liquidity crisis, the only risk management that truly matters is speed.
If you're going to panic, panic first. That is the golden rule of surviving a fire sale on Wall Street.
The aftermath of this was just chaos. I mean, you had regular retail investors, people with their retirement savings in Viacom, watching their stock get cut in half in 2 days with absolutely no news, no bad earnings report, no scandal at the company, just a tidal wave of selling from an invisible source.
It completely baffled the market. And it's such a stark reminder of how disconnected a stock's price can become from its fundamental value. Viacom's business was the same on Friday as it was on Monday, but its market cap was tens of billions of dollars lower simply because one guy in a family office ran out of margin.
Let's talk about the regulatory fallout from this. This had to be a massive wake-up call for the SEC and other regulators.
It was a huge wake-up call, but the question is always whether they'll hit the snooze button or actually get out of bed. It really did expose this invisible hand of family offices and the sheer scale of the capital they control outside of public view.
So what are they actually doing about it?
They are trying to patch the holes in the ship. There are active proposals to amend Form 13F. The big push is to require the disclosure of significant short positions, which have always been hidden from public view, and also to potentially include some derivative positions like swaps.
And there's a specific new rule proposal too, right? 10b-1.
That's right. Rule 10b-1, if enacted, would specifically require the prompt reporting of large security-based swap positions. Basically, it's the Archegos rule. It says if you build a massive synthetic position like they did, you can't hide it anymore. You have to report it. It's all about trying to bring this dark leverage into the light.
And what about the banks? I have to imagine static margining is a very dirty phrase at Credit Suisse these days.
Well, Credit Suisse as an independent entity doesn't even exist anymore. It was forced into a fire sale of its own to its rival, UBS, partly because of the enormous reputational and financial damage from scandals like Archegos and Greensill. But across the entire industry, yes, the prime brokerage business model has fundamentally shifted.
How so?
It's all about transparency now. Banks are demanding to know a client's total leverage across the entire street. If you want to open a big account with Goldman, they now want to see your positions at Morgan Stanley and JP Morgan. The era of blind trust and don't ask, don't tell for these huge multi-prime clients, that's over.
And dynamic margining is now the non-negotiable standard.
Absolutely. No more 24-month bullet swaps with margins that never change. The systems are now built so that if your risk goes up, you pay up immediately. No exceptions.
I want to zoom out for a second as we wrap up.
Sure.
We talked about how this cost the banks $10 billion. But in the grand scheme of a multi-trillion-dollar global economy, is this just a blip? Or do Archegos expose a bigger systemic risk?
I think the consensus is that we got lucky. That is the honest truth. Archegos blew up in March of 2021. The market was still incredibly strong. It was flush with liquidity from the Fed. The system was robust enough to absorb a $10 billion hit without breaking.
But imagine if this had happened exactly 1 year earlier, in March of 2020.
Exactly. Imagine if this collapse had happened during the peak of the COVID crash, when liquidity had already vanished from the system and fear was rampant. It could have been a true contagion event. When a major global bank like Credit Suisse takes an unexpected $5 billion loss, they are forced to pull back on lending across the board. They tighten credit conditions. If they have to pull credit lines from other funds to cover their losses, you get a domino effect that can spiral very quickly.
It really highlights the danger of counterparty risk.
It does. It's a profound lesson. When you buy a stock, you think you're just betting on that company's future earnings, but you're not. You're also implicitly betting that the other anonymous people owning that same stock aren't levered 8-to-1 and on the verge of a forced liquidation. You are financially connected to people you don't know and can't see.
That's a really sobering thought. It's like you're sitting in a crowded theater and you're assuming everyone else is calm and rational. But you have no idea that the guy in the front row is actually covered in gasoline holding a lit match.
And if he goes up in flames, you're going to get burned, even if you're sitting all the way in the back.
We always like to end these deep dives with the one question. Based on everything we've dissected here, the invisible leverage, the risk failures, the regulatory gaps, what is the one question our listeners should be asking themselves when they look at the markets?
I think the question has to be, who else is in this trade with me? And more importantly, can they afford to stay in it?
Unpack that for us.
Whenever you see an asset price moving in what looks like a relentless straight line, whether it's a tech stock, a cryptocurrency, or a housing market, and it seems totally disconnected from underlying fundamentals, you have to ask yourself, is this real organic demand? Or is this just a symptom of massive hidden leverage? Because if it's leverage, the whole trend can reverse itself in an instant. And when that deleveraging process begins, fundamentals will not save you.
The price isn't set by the average holder. It's set by the most desperate seller.
Always. Every single time.
So, to recap the madness, we had a family office, Archegos, using a regulatory loophole to operate in complete secret. They used exotic derivatives like total return swaps and bullet swaps to leverage up 5 to 8 times on a handful of concentrated stock positions.
Turning a $20 billion capital base into a $120 billion tower of exposure.
The banks, with Credit Suisse as the poster child, completely abandoned their own risk management principles. They chose fees over prudence. They let the sales department police the risk department.
And when the tide finally went out, they found out they and their shareholders were the ones swimming naked.
And finally, the prisoner's dilemma kicked in, ensuring that the banks that acted selfishly and sold first Goldman and Morgan Stanley survived, while the ones that hesitated, Credit Suisse and Nomura, were the ones left holding the multi-billion-dollar bag.
A very, very expensive lesson in real-world game theory.
And those regulatory gaps that allow this to happen? They're being patched, but the cat and mouse game between Wall Street innovation and regulation never, ever ends. They will always be looking for the next way to build leverage in the shadows.
That's the fundamental nature of the beast. Capital always seeks the path of least resistance and highest return. Our job as investors is just to try and spot the ghosts in the machine before they decide to crash it.
This has been Talk Tickers. And a quick reminder, none of this constitutes investment advice. Always do your own diligence. Keep your leverage low and keep your eyes open.
And maybe take a peek at who your neighbors are in that crowded trade.
We'll see you next time.